So let us start with options. What are options? We have seen already. Options are instruments which provide insurance against losses. Okay. Now, whenever we are talking of options or whenever we're talking of markets, losses can be mainly because of two things. Number one, you have bought the stock and market went down. There is one type of loss which is possible. Second possibility, you have shorted the stock either in cash or in future and market goes up. So you want insurance in two ways. One is called insurance against a fall, right? You have bought the stock and the stock went down. So you are making losses. Why it happened? Because there was a fall. And other is insurance against a rally. You have shorted the stock and the stock went up. There was a rally. And that is causing the loss. Okay. So both the ways loss is possible. And both the ways you can get it insured. So there are two types of option. One we call option. What is call option? Call option, write down if you want the definitions. Call option is insurance against a rally. Insurance against a rally. And second is put option. It is insurance against a fall. Okay. Now, what is the meaning of call option? Is insurance against a rally. If you buy this insurance, if you buy the call option and there is a rally, call options price will increase. So when you sell it, you will get more money. So whatever is your loss because of the rally, it will be compensated. That is why it is called insurance against a rally. What is put option? Put option is a little tricky to understand. Put options price will increase if there is a fall. So you have bought the stock and you have bought put option. There is a fall. So you have a loss in the stock which you are bought. But the put option will increase in price. So you sell it off and you get money because you own that put option. Because you had bought that insurance. That is the basic aim of options. But nowadays what we do? We buy put option when we feel stock is going to go down. We don't buy the stock. We just buy put option. Okay. And if it goes down, we make money. Or if we feel there is a rally going to be there, we buy a call option. And if there is a rally, price will increase. We sell it. We enjoy the profits. We don't actually short sell the stock. We buy only the insurance. So this way also we can trade options. And actually our course is about option trading. So right now, let us see how exactly do we do it and any other ways of doing it. That also we are going to see. So what is a call option? All right. Call option basically is agreement between two parties to buy a stock at a particular price. Means the other party is making an agreement with you that I will buy this share from you, okay, or I'll sell you share at this price. It is that way. So if you are buying call option, means what you are doing, you are buying the right to buy that stock at a particular price. That price we call strike price. But is it necessary you have to buy it? No, it is no necessity. It's not obligatory on you. You have a right. Now suppose, let us say, I bought a call option and for buying it, I paid money to the seller. That Reliance will go about 2,100 this month end. Now Reliance does not go above 2,100. I had paid money to that person, premium, to buy this insurance. Naturally, what happens? Premium goes to that person. His profit is premium. And Reliance reached only 2080. It did not go above 2100. Will I buy at 2100? I will not buy at 2100. Why? Because it is not obligatory on me. It's not compulsory for me to buy. So fine. I lost money. I lost that premium. Okay for me. But in reality, Reliance reaches 2200. Suppose. Now, can I buy it at 2100? Yes, I can buy. Can that seller of options say, no, now I'm not selling? No, he cannot say that. He has to sell it at 2100. So what I do, I pay him at the rate of 2100 for 250 shares of Reliance, and I take those shares. Then I may sell it. Market price is 2200. I may either sell it or I may either keep it in my portfolio. That is my choice. Okay. So for buying this insurance, whatever money I pay to the seller of this insurance, we call it the option premium. The person who buys options is called as holder of the option. And the person who sells that insurance by taking a risk and receiving premium instead of it, he is called writer of the option. So option writing and option holding, both we are going to study in this course. Okay, and how to do it, when to do it, what strike price, what expiry, everything we are going to see. But I hope the terms are clear. Holder and writer. Holder is the one who buys that option, maybe call, maybe put. Writer is the person who sells it. What holder gets? Holder gets the right, but not an obligation to take that trade. What writer has an obligation to fulfill, and he gets a premium for it. If you have any questions, you can put it in chat box, no problem. Okay. So this is call option. Now let us see, fine. We have understood what is call option, just the basics at least. What is put option? Put option is the right but not an obligation to sell the share at a particular price. That is the strike price. Again, it's not mandatory on the buyer of put option that you have to sell. Okay. He'll decide. But for the seller of the option, writer of the put option, it is mandatory. Now, let us say I have ONGC and I am worried what if ONGC goes down? It may be ONGC in cash or it may be ONGC futures. Now, ONGC, suppose I have bought futures at 115. And I am worried what if ONGC goes down. If it goes up to 110, I am ready to hold. But if it goes below 110, my losses can be astronomically high. So what I do, I bought 110 put option for ONGC. By buying this, what I'm doing, I paid premium to the seller. Okay. And when I pay premium to the seller, he has received the premium, he has sold me the insurance. And in reality, ONGC goes to 100. Now see what I have. I will tell him, I have a right to sell it to you at 110. Now buy at 110 from me. So I will give him 7,700 shares of ONGC and he will have to buy it to me and pay me 110 rupees per share, though the market price is 100. Okay. So seller he has to do it. But suppose ONGC does not go to 110. It remains higher. Okay. Then is it necessary that I have to buy it? Just a moment. Just a moment. Okay. All right. So it's not necessary. Okay. It is not obligatory on me. The ONGC remains at 114. I'm not going to sell at 110. Then what about the money which I paid? That money is gone. Okay. That premium is gone. Just the way if you fall sick, insurance company pays you the compensation. But the premium is what premium you have paid, that you don't get back. Right? Same way, even if you don't fall sick, you are not going to get it back. Correct? So that is what continues even here. So premium is always belonging to writer of the option. Right? Now, what is the difference between a call option and put option? Call option, you have right but not an obligation to buy at a particular price. Put option, okay, I'll explain put option again. See, when I buy put option, what I'm doing, I am buying a right to sell the shares at strike price. When will I do that? I'll do that only if I have the share, but in reality, it went below that price. Now see, I'll given you example. Now let us actually see this example. I have 7,700 shares of ONGC. Why 7,700? Because that is the lot size. We have seen last time what is the lot size. So I am holding 7,700 shares of ONGC. And I am worried, what if ONGC goes down? So I purchase a put option worth 110 strike price. And for that, I paid, say, 3 rupees to the seller. 3 rupees means how much? 3 multiplied by 7700. Understood? So that much money I paid to the seller of the put. So he received that 23,000 something from me. And in returns of that, what he did, he gave me right to sell the share at 110. Now, in reality, ONGC goes to 100. At the time of expiry, it reaches 100. Now, what I will do, I'll tell him, you take this 7,700 ONGC from me. Can he say no? He cannot say no. So he will have to buy ONGC from me. At what rate? 110. That is the strike price. Okay. So I give him 7,700 ONGC and receive from him 110 rupees per share for those 7,000. Though market price is 100, I can now sell at 110. Why? Because I bought that put option. But what about those 3 rupees, which I paid him earlier for buying that option put? Those 3 rupees are gone. So actually, at what rate did I sell my ONGC? It was actually 110 minus those 3 rupees. So 107, effective rate comes 107 for me. And for him, the effective rate is also 107. Okay? Understood this? That is put option. If I buy put option, I can sell at the strike price. Hope that is clear. Okay? If I sell put option, I have to buy if the seller decides to sell at that price. Now, let us see the differences. Call option, we have a right but not an obligation to buy at a particular price. Put option, I'm talking of buyer of that, okay, holder of that. You have the right but not an obligation to sell at a particular price. How much risk are you taking when you buy the option? In both the options, risk is limited to premium paid. Okay. How much profit can you have? For a buyer, profit can be unlimited. Instead of 110, if ONGC reaches 10 rupees, still the seller of the put will have to buy at 110 from me. And I can sell at 110. Understood the power? And call option, if the stock goes, suppose I have bought Reliance, earlier example we had taken 2,100 call, and Reliance reaches 2,500 in this month. I can buy at 2,100 from writer of that option. Okay. So naturally, when the stock price goes up, value of call, price of call, premium of call goes on increasing. Because there is higher probability that those who have bought that call will be in profit. And if the stock goes down, value of put goes on increasing. Okay. So when you are bullish, you buy call. When you are bearish, you can buy put option. All right. Now, let us see the difference between buying and selling options. Buying is bullish or bearish strategy. Selling is not, still bearish or bullish, but not that strong. We'll see this difference a little later. Buyer pays premium to the seller. Seller takes premium from the buyer. Okay. Buyer has a right but not an obligation to buy or sell, I should say, at a particular price. Seller has an obligation. He has to come. He cannot say no. For a buyer, loss is limited to premium paid. For a seller, losses can be unlimited. For a buyer, profit are unlimited. For a seller, profits are limited to premium paid. Only that much profit he will get. For a buyer, how much money he has to give? Same as the premium paid. For a seller, margin is almost same as futures. Whatever margin is required in futures. And buyer is called a holder, seller is called a writer. Naturally, you will say, sir, if it is having so large quantity, magnitude of risk, so little reward, why does anybody sell options? See, probability of profit is more for seller. Probability of profit is less for a buyer. Okay. So statistically, if you consider 70% of the times seller make money, 30% of time buyers make money. The skill is how you can be in those 30%. All right. Then you can be a buyer. And if you don't have that skill, you can decide to be in 70%, where you will be making money by selling the options. In reality, what strategies we'll study will involve both buying as well as selling. It's not everybody is not good at writing options. All right. So if you find you are convenient with it, you can do it. If you say you don't want it, you can go for buying options. Skill will be, as I said, how you are doing it. Okay. And when you do with strategies, you control your risk. Now, let us see if somebody is selling, what is his mindset? What is his position? Selling call is considered to be bearish. Actually, it's not that bearish. Selling put considered to be bullish. Selling call, profit is limited to premium received in both the cases actually. In both the cases, losses are unlimited. And in both the cases, it is obligatory to buy or sell the share at the strike price. Okay, so that is actually a lot of similarity. Now let us understand this. Suppose when will somebody buy a call? Somebody will buy a call when his view is share will go above that price. So he is bullish. When is somebody selling a call? He is selling a call because his view is share will not go above that price. That doesn't mean share will go down. So exactly, it is not a bearish view, but it is not that strongly bullish. So if you are strongly bullish, you buy a call. If you are not bullish about the stock, you can sell a call. But not bullish does not mean bearish. It can be flat. Okay. Same thing applies to put also. Selling put is not that strongly bullish. Even a flat mindset, if you are thinking that the stock will remain flat, it will not go down much, not below the strike price definitely, you can sell a put. Okay. Understood? Abhay, I have not understood what you are saying. This will happen on date of expiry only. I have not understood what you are saying. Now, we have already seen these terms like cost of carry, strike price. So let us not waste too much time on it. So what is strike price? Strike price is the price at which the option will be honored. So above this price, loss will be compensated. That is strike price for call. Below this price, price will compensate. That is the strike price for put. And how much money the option buyer pays to the option seller, that we call the premium of option. Okay. Now, option premium has two parts in it. Write down option premium is equal to intrinsic value plus time value. Intrinsic value plus time value. Now, what is intrinsic value? Okay, write down for call option. For call option, intrinsic value is equal to current market price minus strike price. For call option, intrinsic value equal to current market price minus strike price. For put option, intrinsic value is equal to strike price minus current market price. Strike price minus current market price. For put option, intrinsic value is equal to strike price minus current market price. And write down, intrinsic value cannot be negative. Intrinsic value cannot be negative. So the lowest intrinsic value is 0. It cannot be negative. So suppose we are saying for put option, strike price is 900 and current market price is 920. Our equation says it is strike price minus current market price. So 900 minus 920. How much is that? 0, not minus 20. Okay. Now, in options premium, once you remove intrinsic value from it, whatever is left out is time value. Why time value is there? Now, see, that person who is selling you that option is taking a risk. Longer the time to expiry, more will be the risk. And for taking that risk, he's asking that money. Okay. Naturally, we know 1 year insurance will have certain premium. If we are buying insurance for 2 years, premium will be more. Why more? Because time to expire is more, risk taken is for longer time. Same thing applies here. More the time to expiry, more will be the time value. So intrinsic value may remain the same, but time value will be more if expiry is of the longer duration. Okay. So that is time value. It is the amount associated with time to expire for an option contract. So this is the seller gets. Intrinsic value he has to pay back. See our equation. What is intrinsic value? Call option, current market price minus strike price. Now that much amount he'll have to pay back. If your contract is, I'll buy Reliance at 2,100 and Reliance reaches 2,200, 100 rupees he'll have to pay. What is that? 100 rupees. Current market price is 2,200 minus 2,100, then nothing else but intrinsic value. So write down further. At the time of expiry, buyer of option gets only the intrinsic value. At the time of expiry, buyer of option gets only the intrinsic value. It doesn't get time value back. Time value belongs to seller of option. Okay. Understood that? So intrinsic value, we also call it, this is the net amount receivable for the buyer of a contract. Okay. So we have already seen the mathematical equation for call and put. How much is the intrinsic value? Now, if a stock has, if an option has intrinsic value, it is said to be in the money. When the option has a net intrinsic value, it is said to be in the money. Okay. Now let us take some examples of this. So this will be further clear. Now, just a moment. I'll just share a screen with you, so it will be easier for you to understand. All right. Now let us say the stock is at 105 and it's 100 strike price call option. How much intrinsic value it has? Now we know intrinsic value for call. What is the equation? It is the current market price minus strike price. Right? So how much is that? Naturally, that will be current market price is at 105, stock is at 105 minus 100. So how much is that? 5. Okay. So this 5 rupees is intrinsic value. And we say this 100 strike price call, this is in the money call. Okay. In the money call. And we write it as ITM. Okay. Understood this? Now, let us say 105. The stock is at 105. So second case we are taking, stock is at 105 and 100 strike price put option. How much is intrinsic value? For put, we know that it is, how much is intrinsic value? We know the equation. It is strike price minus current market price. So how much is that? That is 100 minus 105. How much is that? That is equal to, how much is that? 0. Okay, that is 0. And this option, we call it out of the money option, OTM. All right. And if current market price is equal to strike price, we call it at the money ATM. All right. Understood? So if current market price is same as strike price, it's at the money. If current market price is greater than strike price, call option will be in the money, put option will be out of the money. If we take the opposite example, let us say share is not at 105, it is at 95. Now what will happen? For call option, the intrinsic value will be 95 minus 100. So 0. This will become out of the money. For put option, it will be 100 minus 95, 5. This will be in the money. So write down further. Call option is in the money when CMP is greater than strike price. Put option is in the money when current market price is less than the strike price. Okay, so write down these two equations also. Call option is in the money when current market price is greater than strike price. Put option is in the money when current market price is less than strike price. All right, understood all this? Okay. Now, let us see further. Now, before we proceed, any questions in this? Now you can unmute yourself and ask questions. Any questions to anybody? Unmute only if you have a question. Don't unmute without that.
Sir,
Yeah.
Sir, this is Ashish here.
Yeah, Ashish.
You quoted one formula at the very beginning. Something is equal to intrinsic price value plus something.
Premium.
Can you repeat that?
Premium is intrinsic value plus time value.
Time value, okay.
Option premium is intrinsic value plus time value.
Okay.
Okay.
So this formula applies to both
everything,
call and
everything,
put option.
everything. Yes, 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 everything.
Sir,
it applies to everything. Yeah, Vishal.
Yeah. Sir, just you said ITM CMP is greater than strike price. Can you show with the trade tiger or
Sure,
anything?
sure.
So it will be very much clear.
Sure, I'll show it to you. I'll just switch on the trade time.
Thank you.
Any other questions in the meantime? By the time trade tiger is getting switched on?
Sir, Mansi here.
Mansi.
The strike price is means that, as you said, ONGC is trading at 140.
No. Now let me tell you, strike price means what? Mute yourself. If your question is over, mute yourself. Strike price means what? See, remember, everybody will have a view. ONGC will go above 110 or not, above 105 or not, above 100 or not, below 100 or not, above 95 or not. So this is called a strike price. Now, for options, you cannot have argument or your deal with at any price. They are fixed price bands, and they are called as strike prices. Where will you find this? Okay, what you can do is you can go to nseindia.com, and over there you have to look for option chain, equity option chain. So I'll just show it to you first. We'll first answer Mansi's question and then we will see what Vishal has asked. Okay. All right. Now this is the website of nseindia.com. All right. Now see, what do we see here? What we have to do here is, just in this small window, you can give equity option chain. Okay. Equity option chain. Now, when you click on it, you will get a table like this. At the center, the blue colored numbers, it's written strike price. Do you see this? These strike prices are available. Now, this is Nifty. So, right from 12,150, all the options are available at an equal gap of 50 points. All right. And if we see, just a moment. Just a minute. Okay. Now, if you see here, at a gap of 50 points, the contracts are available. 12,150, 12,200, even 12,000 is available right now. Okay. And people are trading also. So 50 rupees, you will find the difference. Now, as you can see, left side, the background is darker. Right side, background is light, white background. Where the background is dark, highlighted, these options are in the money. And where option background is light, it is out of the money. Okay. And you will find, as we go down, here, the background switched. Gray background became white, white became gray, because your Nifty is in between. So this price is in the money. Dark background, gray colored background in the money. I'm sorry. This price is at the money and white background out of the money. And these are the strike prices. 50 points away for Nifty. Now, if I want to check for any other stock, what I have to do? I'll just go up in the same table. Okay. And here I can select any stock. Let us say, for example, Ambuja Cement. If I click Ambuja Cement, as you can see the strike prices 170, 175, 180, 185, 190, or 55 rupees away. The strike prices are available. Nifty, it was 50 rupees. Here it is 5 rupees. If I go for Bank Nifty, it is 100 rupees. So it is decided by the exchange which strike prices will be available. They are uniformly placed. All right. Now, suppose if I go for a stock which is higher in price, okay, then the strike price will not be placed 55 rupees. It will be more. Let us say I go for, say, HDFC. Now, HDFC options, you will find it is 20 rupees away from each other. Why? Because the price of stock is high. So it's not as close as 5, not as big as Nifty. 20 rupees difference. So these different strike prices are available. You can make contract for any strike price. Understood this? Mansi, is it understood what is strike price?
Yes, sir. For better understanding, just clear my one doubt. That what are the options showing on that CNBC channel or Zee News, what I am just saying, that HDFC call for 1450
Exactly,
or
exactly. Now see, this is HDFC.
Price.
See,
Yes.
this is HDFC. HDFC call for this strike price. They will be speaking that way.
Okay.
Okay. Now see, if I want to say HDFC 2540 call is at 98 rupees. Means 2540 strike price call, if I want to buy, I will have to pay 98 rupees.
Okay.
And put is available for 81 rupees. Right side are the puts, left side are the calls.
Okay.
Of that central column. Strike price column, right side are the puts and left side are calls.
Call.
Now, 2450 is for 98. If I go for 2560, 2540, I'm sorry, 2560, which is out of the money. Current market price is less than that.
Yes.
Okay. Where is the current market price? Current market price is mentioned
Okay.
here at the top. As you can see here, 2546.90. This is the current
Yes.
market price. So anything having strike price less than 2546 call option is in the money. Okay.
Okay.
And
Hmm.
strike prices above 2546 are out of the money. So if I go for 2560, it is out of the money. Its price is less than this. Now, if I say 2540 call, now see, pay attention, all of you. What is the price of HDFC? 2546.90. And I'm talking of 2540 call. How much will be the intrinsic value?
6.
6 rupees 90 paisa is the intrinsic value.
Intrinsic value, right?
Okay. So, how much is this call available for? This call is available for 98.60, 98.30. Okay. Let us say 98.60 for convenience. So, this 98.60 is intrinsic value plus time value. Intrinsic value is 6.9. How much is the time value? 98.30 minus 6.90. That is the time value. That is
Okay,
91 point something will become time value.
Huh.
Understood this?
Sir, please repeat this.
Huh.
Okay.
Please.
Okay. Now see, this 2540 call option. What is the price? 98.30. That is the premium.
Okay.
So what is the option
Yes.
premium for this call? 98.30. Out of that, how much is the intrinsic value?
6.9.
6.90. But our equation says premium is time intrinsic value plus time value.
Hmm.
So 98.3 is equal to 6.90 plus time value.
Okay.
So how much is time value? 98.3 minus
6.9.
6.90.
Okay.
Okay.
Understood this?
Yeah.
Now let us take another example here. 2520 call is at 111. Okay, 2520 call is at 111. Premium is 111. How much will be the intrinsic value in this?
26.9.
26.90. How much will be the time value? 111 minus 2690. Understood?
Yes.
Let us take 2560 call. It is at 86. 2560 call is at 86 rupees. How much is the intrinsic value?
86.95.
Intrinsic value.
Hmm.
See the equation. Current market price minus strike price.
0.
It's zero.
Zero.
Sir.
So how much is the time value? Entire 86.95 is the time value.
Time value. Okay.
Understood this much?
Yes.
Now for put, calculation is same way, only equation is opposite. Other way around, same way you find out time value and intrinsic value. Okay. Now please mute yourself if you are not asking question. Now let us see for put. 2560 put. It is available at 91 rupees. 95 rupees. I'm sorry. Buyer is at 91, seller is at 95. So 95 it is available. Out of that, how much is the intrinsic value? 2560 minus 2546.90. So 13.1 is the intrinsic value. And 95 minus 13.1 is time value. Okay, so 81.9 will become time value. For 2540 put, entire 81 rupees is time value. There is no intrinsic value. If you go on the higher side, 106 minus that 33.1, that will be the intrinsic value. Rest is time value. Understood how to find out intrinsic value, time value, in the money, out of the money? Yes or no? Any doubts still to anybody? Want more example in this? We'll take some smaller stock. So it will be still clear. We have talked of ONGC. Let us really go to ONGC. Come on. It will
Hello,
be
sir.
easier. Smaller figures are easier to understand.
Hello, sir.
Yeah.
Can you just take one example of Bank Nifty in this case?
Just a minute. I'll take.
Okay, sir.
Now let us see. This is ONGC. As you can see, it is at 1 rupee. Strike price is changing. 1 rupee. Can you see that? 110, 111, 112, 113.
Yes, sir.
Now see. Where is ONGC right now? ONGC right now is 115.40. Now let us see the same thing here. 115 call. Current price is 115.40. So what is the intrinsic value? 40 paisa.
Right.
115.40 minus 115 is 0.4. Now this is priced at 6 rupees. So out of 6 rupees, how much is the intrinsic value? 40 paisa. How much is time value? 5.60. Understood this?
Right.
If I say this call, 116 call, it is available at 5.70. How much is the intrinsic value?
0.
0. So entire thing is time value. Okay. Understood this? So all these above, higher prices, higher strike prices, all the calls are only time value. As the call goes away in price, risk is less, time value is less. Those which are in the money, they will have both the things, intrinsic value as well as time value. For put option, it is the opposite. Okay? Understood?
Yeah.
Any questions now? Now I take this Bank Nifty. Bank Nifty. Okay?
Sir, may I
Huh.
ask one question only?
Yeah.
As per your experience, what you suggest, in the money call is better or out of the money call is better?
For what? Buying or selling?
To buying only.
Now, if your view is strongly bullish, it's at the money or slightly out of the money is better.
Okay.
But there are different conditions under which one is better than the other. Everyone has some advantages, some disadvantages. Okay?
Okay.
So each one has some plus and minus. We are going to discuss everything whenever we reach respective stages. Now, Bank Nifty. Let us see about Bank Nifty. Same way, where is Bank Nifty right now? 35,228. All right. So, Bank Nifty options are 100 rupees away from each other. Strike prices are 100 rupees apart. Now, as you can see here, 35,200. So 35,200 called. How much is the intrinsic value? 35,228 minus 35,200. 28 rupees is the intrinsic value. And it's priced it at say 669. So 669 minus 28. So 640 rupees is time value.
Sir, what is the difference between this ask price?
Yeah. Ask and bid. Bid price is what the buyer wants the things for. Buyer is ready to pay how much? That is called the bid price. And seller is willing to sell for what? That is called the ask price. Now here if you see bid price, see buyer wants it at 640, seller is asking for 669.95. Okay? So difference between them is called a spread. Sometimes people call it bid ask. Bid ask means difference between bid and ask. Unless bid ask becomes zero, there will be no deal. Trade can take place only when buyer's price and seller's price are matching. No? The buyer stands at 640 only, I will not give more. Seller says, no, I will not sell cheaper. There will be no deal.
So,
Okay.
So the price of deal is visible here on this chart somewhere? Or can I understand that LTP, latest traded price?
Later, last traded price is where the actual deal took place. Last traded price, that is LTP. Change. How much has the option premium changed in one day? Okay.
So
This IV
previously
is not
the
intrinsic value. This IV stands for the implied volatility. Okay. Volume. How many shares, how many contracts changed hands? Not shares. How many contracts, how many lots changed hands? That is the volume. Open interest change. How many new positions are created? We are going to see open interest. We have seen in future. Same way there is open interest in option also. How much is the total open interest? On left side for calls, on right side for puts. Yeah. Any other question?
so previously the option chain table was looking different. Now they have changed the
No,
format.
it's same. It's same. It is same for years. Only thing is, slight difference in color is there. They were using a buff color earlier. Now they are using just gray and white. Earlier it was
No,
buff.
the OI figures were also different, sir, in a larger
See,
number.
basically what happens nowadays, this is every week. Expiries are every week. That is why the volumes are smaller, you are seeing. Earlier it was monthly, na? Only monthly
Okay,
contracts
sir.
were there formerly. Now there are weekly contracts.
Okay,
That is
sir.
why open
Okay,
interest is relatively less. It gets divided now. Yeah. Any other doubts?
Sir, like this in the option chain in the BSE, we can see the strike price of different spots, different shares.
Yeah.
In case of if you want to see the ONGC future price, where we can see this in the NSE
No,
side?
this is the option chain. This has nothing to do with future.
But if
Okay.
if you would like to see this,
All of you, I will suggest one thing. Go on this side and just explore it. It gives lot of information. Lot of information. Just search. You will find everything over here. Okay?
okay.
So right now, let us not waste too much time on this. You will also find for currency, for interest rates, for commodities, everything. Interest rate futures and options are going to start soon. That is why they have already made the provision. All right. For commodities, different commodities, everything you will find over here. Okay. Fine. So this is about the option chain. Now, Vishal was asking something. Vishal, what you asked in Trade Tiger?
Sir, actually, you have cleared out.
You're cleared that down. Okay,
Yeah.
fine. So nothing left now.
Yes, sir.
It's fine. So again, mute yourself, all of you. Let us continue with further theory. Okay. Now we start with the option. Mute yourself, please. Mansi. Okay. Now see, pay attention. Now we are talking of the option Greeks. Okay. These Greeks largely decide on how much will be the premium of the option. So let us see what are these option Greeks. First option Greek is delta. Delta is the change in price of options premium with respect to change in the price of underlying stock. Means what? If share goes up by 1 rupee, how much that option will increase or decrease in price? That is delta. Okay. So just a moment. All right. Now suppose HDFC goes up by 1 rupee. That option which was at 111 will reach where? That is delta. Usually delta is between 0 and +1 for calls, and it is between 0 and -1 for the puts. Why the minus sign? Because if the stock goes up, put comes down. If the stock goes down, put comes up. They are opposite to each other. That is why the sign is negative. All right. But at the same time, just remember one thing, that though the prices are opposite, what we are interested in is the absolute magnitude. and total delta of a call and put of the same strike price, the sum is always equal to 1. So delta of call plus delta of put, only the magnitude, total will be 1. Okay. But delta is not fixed. Delta keeps on changing as the stock moves, and delta also keeps on changing as the expiry comes closer. Okay. So what is the delta? Delta is change in price of the premium with respect to change in underlying. Now see what happens. Let us say a stock is at 100 rupees and its delta is 0.4, let us say. If stock goes from 100 to 101, delta will change. It will become 0.4 to 0.43. So how much has delta changed? Delta has changed by 0.03 out of 0.4. Are you understanding this? I repeat, pay attention. Stock has gone from 100 to 101. Delta, which was at 0.4, becomes 0.43. Means option has changed by how much? 0.4, option premium. But now for the next 1 rupee, it will change by 0.43. From 101 to 102, it will change by 0.43, 43 paisa. From 102 to 103, it may change 45 paisa, 46 paisa, something like that. Okay. So likewise, if it actually goes from 100 to 110, you will find delta may go from 0.3 to 0.6 or something. Because it also keeps on changing. Delta doesn't remain constant. So for first rupee, it may be 0.42, second rupee 0.45, third rupee 0.48. Likewise, it will keep on changing, and by the time it reaches 10 rupees higher, delta will be going higher, or the change in price will be faster now. And when it becomes 1, that means if stock goes up by 1 rupee, the price of option also goes up, a premium also goes up by 1 rupee. That happens when an option is very much in the money. We say it is deeply in the money. So for deeply in the money option, delta is close to 1.
ऐकते ते काय दाखव दे नुसतं बोलतायत काय दाखवत
Please
नाहीये
keep yourself mute. That is the problem. People just don't understand when I say they keep mute. Okay. Now see, delta keeps on changing as the stock goes more and more in the money. Right? Naturally, how much is delta when the stock option is at the money? At the money option has delta very close to 0.5. As it goes in the money, the delta goes on increasing very fast. Whereas if it is out of the money, delta is less than 0.5. And if it starts falling, stock starts falling, delta will go on decreasing, but the decrease will also be slowing down. And how will delta change for every 1 rupee? That is given to us by the next Greek, that is called gamma. So gamma tells you how delta will change. Now note down, for add the money option, delta is 0.5. For add the money option, delta is 0.5. For in the money option, delta is greater than 0.5. For out of the money option, delta is less than 0.5. Okay.
Sir, can you repeat, please?
I repeat. For ATM, add the money option, delta is 0.5. For in the money option, delta is greater than 0.5. And for out of the money option, delta is less than 0.5. Okay. And gamma tells us the rate of change of delta with time or with price, both actually. Just make that correction. So delta indicates rate of change of delta with time or with price. Okay. Now let us understand this delta very well. What is the meaning of delta is 0.5? Delta 0.5 means there is 50% possibility this option will end in the money. Understand this is very important. Delta is equal to 0.5 means there is 50% possibility this option will end in the money. Okay. See, we are talking of possibilities. There are no guarantees in stock market. Probabilities. So probability is high, this option will end in the money. Okay. So as option goes in the money, delta goes on increasing. That is not the case of gamma. Gamma is highest for at the money option. Gamma is highest for at the money option. When the option goes in the money or out of the money, gamma starts decreasing. When the option goes in the money or out of the money, gamma starts decreasing. Okay. Now the third one is theta. Theta is the measure of time decay in options premium. Means what? Now, if you see today it's 7th of March and we have seen some time value is there. As the expiry of 25th March comes closer, time value will keep on decreasing. And this time value will become 0 on 25th of March at 3:30 p.m. Why? Because now it is there is expiry already. It is expired. Okay. And this is given to us by a graph that is called time value curve. Now see, this is a very important part in options. And majority of people neglect this. So let us see what is a time value curve. Okay. Now, let us take a simple example first. We'll see with the picture, so this will be clearer. What is time value curve? Time value curve tells us how the time value changes with time. Okay. So time value, it goes on decreasing as the time to expiry comes closer and closer. But how exactly it changes? That is called time value curve. Now let us see exactly what is time value curve. Okay. Now pay attention here. Let us say, for example, I'll just draw a graph. Okay. Here is the x-axis. Here is the y-axis. Okay. Now, y-axis gives us the time value, and x-axis gives us weeks to expiry. Okay. But it is not as usual scale 1, 2, 3, 4. In fact, this is slightly opposite. All right. So this is, suppose there are 4 weeks to expiry. Okay. Then 3 weeks to expiry. 2 weeks to expiry. 1 week to expiry, and actual expiry. All right. Now let us say, for example, initially the time value is here, and on the expiry day it's going to be 0. But it doesn't change this way. All right. How it changes is, it takes a curve like this. Means, in other words, if I am talking of how much is the decrease in time value from 4th week to 3rd week, the decrease will be only this much. Okay, I'm sorry. Let's go for a straight line. So 4th week to 3rd week, the decrease in time value will be only this much. All right. So it has decreased only from here to here. From 3rd week to 2nd week, if you see, the decrease will be slightly more than before. From 2nd week to 1st week, the decrease will be significantly higher. And in the 4th week, the time value will simply collapse. All right. This is called your theta curve or time value curve or time decay curve. Decay means what? Disintegration. Right. So this is called the theta curve of the option. And it looks like this. Initially, the decrease is less. Then it starts increasing. And in the last week, it is very fast. What will happen on the last day? If we go for the last day, what will happen? Suppose if we are talking fraction of a day, a fraction of a week. In last week, if the decrease is this much, you will find almost half of it, okay, or half of it is lost in last 2 days. Now just tell me one thing. Time value is only decreasing. Intrinsic value may increase or decrease depending on price is increasing or decreasing. What will happen if you buy a call option in last 2 days? Intrinsic value will increase, but time value will simply nosedive. So it is possible intrinsic value increase. As you were expecting stock will go up, you bought a call. Intrinsic value increased also, but the decrease in time value was more than increase in intrinsic value. And then you will be at loss, even though your view was correct. Why? Because you bought the wrong option. Last 2 days, you should avoid buying options. Buy for the next expiry. Don't buy for that month. Don't buy for that expiry. Why? Because in last week, time decay is the fastest. In fact, last 1 day, 2 day, you should think of selling options. Don't sell it without understanding. Why? Because time value you are going to get. All right. So after we finish a little more theory, we are going to see how to sell options for profit. But not today. It will take some time. All right. So theta curve tells you how the time value will decrease. And this decrease tells us it's not advantageous to buy options in the last week. Which have expiry very close, don't buy those options, buy for a longer expiry. Okay, any questions here?
So, Amulya.
Yeah.
So that means while buying any call or put option means we should avoid buying it on Wednesday or Thursday in case of
No, in case you want to buy on Wednesday or Thursday, don't buy it for that Thursday's expiry. Yeah. Buy it for next expiry.
Definitely, definitely. Okay. And so is there anywhere where I can or we can see this graphical presentation?
Yes. Not graphical representation. Graphical you don't get.
Okay.
But the numbers you get.
Okay. Okay.
Now where do you get how much is delta, how much is gamma? Let us see that right now.
Okay.
Right away we'll see. Now see, you go to your trading software. It will be there. You will have to search where is it. Now let me tell you for Trade Tiger, where is it? In this top bar, you go to tools. And here, go to option calculator. Okay. Of course, what you have to do is you click on an option before that. Let us say I'm talking of 15,000 put, which is expiring on 25th of March. Sufficient time to expiry. This will not give you correct figures very close to expiry because they round it up. And then anything above 0.9 comes to 1. Okay, and anything less than 0.1 appears to be 0. Sufficient time to expire is there, then you can check this. See here. Now see here. Option type, it is 15,000 call. What is the value of option? 156. What is delta? 0.56. What is theta? Minus 6.1. The theta is always negative because time value only decreases. Time value doesn't increase. How much is gamma? Gamma is 0.0012. Vega is this much. Vega we have not seen. Rho is this much. For put option of the same strike price, option value is here, delta is here, theta is here, gamma, vega, rho. So all these you will find under tools and option calculator. Okay. So all these 5 for this option are listed over here. For other option, you can also find out, no problem. Same way, you will be able to find for any option. All right. Now, theoretically, as I said, add the money, it should be 0.5. In reality, it may not be 0.5. This is actual value. Theoretically, it should be 0.5. It is not 0.5. Actually, this is in the money. So call delta should have been less than put delta in reality. But here call delta is more because the actual figures are there. So whatever is actual is actual. We don't argue with it. We can't argue. That is because people don't always check this. They just take some emotional decision. But invariably, if the delta is this much, that indicates this option is higher in value and it is advisable to sell such an option. When option is at higher price compared to its theoretical calculated, we say the option is rich. And usually, option which is rich demands selling. If theoretically, if the actual value is less than the theoretical value, we say option is cheap. If the option is cheap, it is suggested that it may be advantageous to buy that option. Okay. But understood how to find out the 5 Greeks? We'll see about Vega and Rho. We have seen only delta, theta, and gamma. Now let us see what exactly are Vega and Rho, the remaining 2 Greeks. Okay. Now, what is Vega? Vega deals with volatility. More the volatility, more is the option premium. Right now, you will find volatility is very high. Okay. India VIX is about 25. And as India VIX is about 25, Vega is high. That will increase the premium of call as well as that will increase the premium of put. And lastly, Rho. Rho is the measure of change in interest rate. So that depends on what is interest rate declared by RBI. Rho doesn't change every day. Rho will change only when RBI increases or decreases the interest rates. Okay. So interest only when the days are that interest rate is fluctuating, Rho has to be taken into consideration. When the interest rate is not fluctuating, Rho is going to remain constant. Okay. Understood this. Now, any doubt in these 5 Greeks before we proceed? Any questions or should I continue?
Here, as compared to the theta curve which you showed some time back, so in the last week, is it advisable to go for out of money options? Does it mean that
for buying or selling? What you're saying?
For buying.
No, you should not buy options in the expiry date where expiry is very close.
Okay.
Buying is not advised. Out of the money to absolutely not advised.
Okay.
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 Any other question? All right. Now let us continue further. See, basically what happens, options are of two types. One is called American option, other is called European option. Now let us see what are these. European option means, see, we said just now that a buyer of the option gets back the intrinsic value. We have seen that. The question is when. European option means only on the expiry day, the buyer of option can say, give me the intrinsic value back. All right, give me my money. And how much will he get? Intrinsic value he will get back from the seller of that option. American option means you can ask that money any time before the expiry. Any day. You will not get the time value back. You will get only intrinsic value back. But you can ask for that any day before the expiry. And this is called as execution of an option. Naturally, as you are going to get only intrinsic value back, which options can you execute? You can execute only in the money option. If it is at the money or out of the money, you will get back zero if you try to execute it. Time value you are not going to get, and they have only time value. So you will get only intrinsic value back. So which options can you execute? Only those which are in the money. Who can execute? Only buyer can execute. Buyer or holder of the option. Writer cannot execute. Writer has to hold it till expiry. If he wants, he can close it by buying back that option. That is different, but he cannot execute. So let us consider, say our example, which we have seen already, ONGC. ONGC is at 115. I have bought 115 call, but ONGC goes to 120. Now I am worried, what if ONGC comes down? So what I do? I ask my broker to execute that contract on my behalf. Naturally, what will my broker do? Broker will give an order to the exchange that this order is to be executed. Okay. So the instruction reaches the exchange that 115 call option of ONGC is to be executed at 120 rupees. At 120 means current market price is 120. So how much money I will get? I will get 120 minus 115, 5 rupees per option I will get back per share. All right. So fine. Now there will be hundreds of people who have actually sold at 115 call. So what NSE does, at random, they will see how many people have executed. All right. 50 people have executed their option and there are 300 people who have sold that option. So out of those 300, any 50 at random will be told your position is now closed and 5 rupees we are deducting from your account. Directly they will deduct. They will not ask you to pay or anything. They will directly deduct and give that money to buyer of the option. This is called as assignment. But which contracts can be assigned? Only American options can be assigned. European options, you cannot execute before the expiry. American options, yes, you can execute that. And this assignment, naturally, you are not going to get time value back. That is the loss for the buyer. But then why should any buyer assign a contract? Let us see that also. As he is going to lose time value anyway. When an option goes very deeply in the money, time value becomes zero. And sometimes time value even becomes negative. So if the person goes to sell it, he will get less money. Instead execute it, he will get more money. Now, this is beginning of the month, so you will not find that type of contract. But near the end of the month, such type of contracts, many times we find it. Okay.
So
And,
this,
yeah.
so this American option also traded in BSE or NSE?
Yeah, I'm coming to that. I'm coming to that. Okay. Now see, in Indian markets, index options, Nifty, Bank Nifty, Financial Nifty, they are European options. Okay. And all stock options, they are American options. All right. Stock options are American options. Now let us see here. Good example. Just a moment. Yeah. I'll just show you a nice example. Now see, ONGC. What is the price of ONGC? ONGC price is 114.95. Now let me call it, say 90 rupees strike price call, 90. 90 rupees strike price call. How much is the intrinsic value for it? Current market price minus the strike price. So 114.95 minus 90. That is 24.95 is its current intrinsic value. But if you see the last row here, 90 rupees call, the buyer is ready to pay only 24.80 for it. When actual intrinsic value is 24.90, buyer is saying, I'll pay maximum 24.80 for it. Now the question comes, what should you do? You have bought it. It has come in the money, but there is no buyer who is willing to buy at that price. Now, what can you do? Either you give it at the lower price to the buyer, or you execute it. When you execute it, you are going to get some extra money, because right now, if you see, if you put everything in our equation, you will find that last traded price is 24.10 for it. Means, how much is time value? Time value is minus 0.8. See if you understand it. Intrinsic value is 24.9. But last traded price is 24.1. And our equation says premium is equal to intrinsic value plus time value. So how much is time value? Minus 0.8. As I said, in the beginning of the month, it is not much. But at near the end of the month, you will find this very much skewed. Then it is better, instead of selling at cheaper price, the holder of option can say, I execute it, pay more money now. And then whoever is assigned will have to pay back. And as I said, which options are American options? In India, stock options are American options. Okay. So actually what we call CE and PE, for stocks, it should be CA and PA, call American and call put American. Whereas CE and PE are applicable for European option, call European, put European. That should be for the index. Okay. So assignment and execution is possible only in American option. It is not possible in European option. Okay. Any questions in this to anyone? And which options can be assigned? Only in the money. Out of the money, at the money, you cannot execute, you cannot assign. Now, sometimes this assignment also benefits you. All right. How does it benefit? A simple thing. A few years back, I remember very much. Nowadays, I don't write options. But long back, there was Cairn India, CAIRN. And I sold one lot call of Cairn for 9 point something. 9 rupees something. And 1600 was the lot size. And that very evening, it got assigned to me at something like 2 rupees 70 paise. Means what I sold for 9 rupees, I was forced to buy it back at 2 rupees 70 paise. Fine. Next morning, I again sold. I got profited in it. All right. But this is the thing that happens. Sometimes this is advantageous. Sometimes it gets assigned even when you have no intentions of closing that position. You have intentions of holding it, but it was assigned to you. So compulsorily your position is squared off. Even that can happen. All right. So all these things are possible in options. What we have studied is the basics of options right now. What are options? What are types of options and the different terminologies? Any questions in it? I'll answer first. Anything not understood so far?
So just now you have taken an example of one stock, ONGC, and that was showing the CE. CE stands for the European option, right?
CE is European.
So you said that all the stock option will be
American.
then
American.
So here they are mentioning European.
Yeah, they do it. I don't know why. See, SEBI is saying that they will be slowly, steadily switching to European options only, but as of now, they have not switched so far. Not to the by best of my knowledge. If they have switched already, I don't know. Okay?
Okay.
It
Thank
should be CA and PA in reality.
Yes.
But they always show it CEP.
So my question is
Hmm.
that if delta is increasing, that means stock price is going to increase, or is it?
See, delta is increasing doesn't mean stock price is increasing.
Okay.
Because delta will also depend on other factors.
Okay. Got it.
Okay. And increasing means what? For put, delta is always negative.
Right.
So if you say for put, delta will be decreasing if the stock price is going down, right? When actual magnitude is increasing, but because of negative sign, it will appear it is decreasing.
Okay. Okay. Got it.
All right.
Yeah.
Any other question?
So delta is predefined or
Delta is calculated depending on the current change in price of option premium, observed of change in premium.
so there is no specific formula for it. It is always predefined.
Basically, you know what happens? What is the time premium? Whatever is the time premium, total premium, it is a fact. And calculations don't exactly justify the fact. Especially in Indian market, you will find most of the traders, they will just think it is cheap and they will buy it. They will think it will go up, they will buy it. They don't think about gammas and deltas and all. Okay. So truly speaking, depends on, there is a factor called implied volatility. And implied volatility is not calculated. It is based on observed value. Okay. So it will just help you in understanding, is it worth buying this option or not worth buying option? We have different equations. How to calculate fair price for an option. What you do, you just just Google option calculators. Okay, option premium calculator. Now, option premium calculator, when you Google, you will be shown a table. It will ask for certain parameters. Once you give that, it will calculate and it will tell you how much should be the price of that option. All right. Now, how much is the price of option is a different issue. Now, let us see this. See, it is asking you spot price, strike price, how much is the interest rate, how much is the volatility. Then it asks you which day you want to purchase. It will ask you what is the expiry date. The difference between the two is always taken in number of years, not days. So whatever you give in days, it will divide it by 365 to convert it to number of years. Not trading days, all days. Even the holidays are counted in it. And based on that, you will be getting how much should be the fair price of option. All right. But actual volatility, nobody can exactly calculate it. It is done the opposite way. From the price of option, implied volatility is decided. And then you use the same thing for the next option and decide whether it is worth buying or not. It's a comparator method, what we call it. And accordingly, we find out whether a particular option is more expensive than what it should be or less expensive than what it should be. If it's more expensive, don't buy it. It is worth selling it. If it is less expensive, you can buy it. Best strategy here becomes, you buy one option, sell other option. You buy 15,000 calls, sell 15,200 calls. They will cancel the anomaly between each other. If one is more expensive, other will also be more expensive than what it should be. So what extra you have paid, part of it will be recovered immediately because they cancel each other. Okay. So implied volatility, either you can take it from the column of NSEindia.com website, which I showed you, IV. IV stands for implied volatility. So that figure you have to put here. Interest rate at present is 10%. It is all the calculations are based on 10% interest rate. So that you have to give 10%. Okay. Strike price, which strike price option you are talking of. Spot price, it will tell you what is the current spot price. Okay. So you can fill in these 4 things. You can fill in purchase date. You can fill in expiry date, call option or put option. And then this will give you how much should be a good premium, fair premium for it. Then you can decide whether it is worth buying or not worth. All right.
Yes, sir.
So all this, you can just Google any calculator you take. Mostly they use Black-Scholes model. In India, option premium are calculated using Black-Scholes model. There are many models. Put call parity model is there. Many are there. So let us not bother about that. Just fill in the values and you will get it. But as we are going to study the strategies, these quite in most of the strategies, this will be taken care of. This is necessary if you are buying naked call, naked put, then you have to see whether it is fairly priced or not. Other way around, if you are buying one call, selling other call, automatically they compensate for the errors. To some extent, not 100%, but some extent compensation you will always get. Okay. So any other question here to anyone?
Good evening, Rohit here.
Yeah, Rohit.
So I just told that option selling, but option selling require a huge means for a selling I have to pay the all money. I think all brokers are
No,
taking-
you have to pay. I have already given this point. You require same margin as future. As much future buying or future selling requires margin. Last week we had discussed those. So
option
same margin
selling
you will require
means
here.
all selling.
Yeah. For selling naked call, you require same margin as future.
So there is another just query means as I am in this industry as a for a technical support from last 10 years. So in 2010, so my colleague has just teaching this call put option. So that's why at that time they're just telling in this layman language that's call European means I can buy. That time there was no weekly expiries, so I can buy a call means or put at any time, and European expiry allows me to sell before the expiry, and the American.
Even Americans allow. Even Americans allow.
But at that time they told me that American
See,
allows.
what they told, I am not responsible.
Okay.
American options you can execute before the expiry. European options you cannot execute before the expiry. What your colleague told you, I am not responsible for it. I am not answerable. Either he told you wrong or you understood it wrong. The difference between these two is when can you execute. Okay.
So means if I buy, suppose tomorrow I buy the European for Bank Nifty European.
You can sell it after next minute. You can sell it.
So this allows the European.
See, selling is allowed in everyone.
Okay.
Execution is not allowed in European before the expiry.
Okay.
American can be executed before the expiry.
Okay.
European cannot be executed before the expiry. If the option is in the money, in American option, you can say, bring my money. I want my intrinsic value back right now. Europe, and that is calculated based on last closing price of that stock on that day. Okay. European, you cannot execute. That is the difference between the two.
Okay. Okay. So means I understand that the execution means sell. That was the
Execute is not sell. Execute means forcing, demanding your intrinsic value. Execution is not sell. You are closing the position compulsorily. That is execution. You get back the intrinsic value. That's it. Settle the score. That is called execution. Suppose expiry is on 25th of March, but on 20th of March I decide, or 18th of March I decide, no, I don't want to sell it. I'm not getting enough money. Seller is so buyer is not ready to pay me money, so I want my money. I want my intrinsic value. So what I do, I give execution order. The position will get closed, and I will get the intrinsic value back. Okay, that is execution.
Understood.
That is not selling. Selling is between 9 to 3:30. Execution takes place after 3:30. Based on what is the closing price of the day. So what is the difference between strike price and last traded price of the day, after closing price of the day? That much difference. If it is in the money, I get back that intrinsic value. So I close my position. That is execution. Okay. Selling means between 9:15 to 3:30, you place a sell order and it is sold. That's it. You get time value. If it is there, you will get time value back. Okay. So that is the basic difference between the two options.
Hello, sir. Amol here.
Yeah, Amol.
So I don't know whether my question will be right. I just
Question
want
is
to
always right. Don't
Okay.
worry. No.
So I just want to understand how this delta, gamma, theta is going to help, or how we can judge
Yes,
on basis of
yes.
this.
Now
whether
see.
we should.
Now see. Let us take an example. So this will be further clear. Okay. Now let us see this 90 call of ONGC, which is 24 rupees in the money. Let us see what are its Greeks. See how much is the call delta? 1.000. All right. Means if stock goes up by 1 rupee, this option will go up by 1 rupee.
Okay.
Understood?
Okay.
On the other hand, let us take another call. I'll take 220 call. 120 call here. ONGC 120 call. Now it is priced at 4 rupees 15 paisa. And let us see its delta. Its delta is 0.06. Means if ONGC goes up by 1 rupee, this will not even increase by 10 paisa. Okay? Understood this?
Got it. Got it.
So if I'm buying a call of ONGC, suppose if I buy 120 call, how much will it increase? ONGC goes up by 1 rupee, it will just hardly increase. Hardly any profit I will get.
Okay.
On the other hand, if I say, if I just add the same price here, what is ONGC? 115. So if I say 115 call, then how much is the delta? Delta is 0.66.
Okay.
Means if ONGC goes from 115 to 116, this option premium will go from 6 rupee to 6 rupee 70 paisa.
Okay.
65 paisa or 70 paisa, because 66 there is no trade. 5 paisa gap is there. Okay.
Got it.
So delta helps me. Should I buy 115 call at 6 rupees or should I buy 120 call at 4 rupees? Which is 120 call is cheaper.
Right.
But if price goes up, even the profit will be very less. Compared to that, putting 6 rupees is more logical.
Right. Got it, sir.
Understood?
Yes, sir. Yes, sir.
Again, when we say delta is 0.66, what does that tell me? That means there is very high possibility this option will end in the money. Now, in the money can be by 5 paisa or whatever. That is immaterial. But probability of this option ending in the money is very high.
Oh, high.
But if I say 120 call, their probability is less than 10% that it will end up in the money.
Definitely. Got
So
it.
delta helps me in understanding, should I buy this option or not? If delta is very low, if delta is less than 0.2, it is not advisable to buy that option.
Okay. Got it, sir.
Usually that ends up in the losses.
Okay.
Sir, excuse me, sir. Can I explain for one Bank Nifty example? 35,300 call option.
Yeah, just a minute. Just a minute. We take this near expiry. Which expiry you want?
10th March.
10th March. Okay, fine. Now let us see. We'll take 10th March and we'll take 25th March. We'll take both.
Okay, sir.
Okay. Now see 10th March. If I see its delta is 0.58. Means around 58% possibility it will end up in the money. Delta multiplied by 100. It just gives you approximate, not very accurate, but approximate probability. Okay. But the same option, if we take for a longer expiry, then the delta is slightly better. Do you see this? This is 0.61. Okay.
Okay.
So probability is around say 60% that option will end up in the money. That doesn't necessarily mean it will end up in the profit. And it will be end in the money. That's it. Okay. But if I want to buy a option, I will say buying 25th November option is more likely to give me money than buying the 10th March option. Of course, this is because the price is very, very close. In the money, already there is 80 rupees, 80 points. How much it is? Where is Bank Nifty? Sorry, here it is. It's slightly out of the money. If I go for deeply out of the money, then the same equation will be still skewed. Instead of 35, I'll go for 36,000. Okay. So if I say 36,000 call, this will be further clear. Now see, 10th March 36,000 call. How much is delta? Delta is 0.025 or roughly 2.5% possibility it will end in the month. Understood? Very low delta. So if Bank Nifty goes up by 1 rupee, price of this option will go up by 2.5 paisa. So not even 5 paisa change. All right. On the other hand, if I take 36,000 call for the same, but expiry is longer, here it is 28. Delta is 100 times almost higher. No, not 100, 10 times higher. I'm sorry. 10 times higher. Means if Bank Nifty goes up by 1 rupee, 10th March, 36,000 call will go up by 2 paisa. But 36,000 only, but 25th March will go up by 28 paisa. Understood? Now, 28 means somewhere between 25 or 30. There is no deal at 28. So the nearest 5 paisa multiplier. Okay. So naturally, if I want to buy Bank Nifty call, which Bank Nifty call should I buy if I want to buy for 36,000? It is not advisable to buy 10th March, but I may buy 25th March for the same expiry, same strike price. So I can decide which option I can buy used on this delta.
Right.
Understood the use of delta?
Right.
And delta depends on gamma. So gamma is also useful. And theta tells me how the time value will be decreasing. So theta is also useful. That is the importance of this. It helps us decide which options can we buy, which options can we sell. Now, pay attention here. 36,000 Bank Nifty call. It is priced at what price? Say 800. 799 is the seller. So let us say 800. And this is at what price? 320. What if I buy for 36,000 on month end and I sell for 10th March? Both if I do tomorrow morning, what will happen?
Will just reduce your risk, sir.
I am reducing my risk. Risk comes below 500 points straight. Understood the strategy?
Yes, sir.
I buy 36,000 call Bank Nifty for 800 rupees. And I sell 36,000 call 10th March expiry for 320 rupees. What I have done, I have reduced my risk to 480. That doesn't mean you should do it tomorrow, okay? I'm just giving you an example.
Yes, sir. Yes.
So can you just repeat again for this example? You are buying call of 36,000.
I am buying longer expiry call and I am selling shorter expiry call for same strike price.
Sir, can I ask a question?
Yes, why not?
Sir, what is the importance of the ratios of the Greeks? Like, is there a lot of people talk about theta vega ratio? So is it important?
Not important at all.
Okay.
Just don't bother with it. You know, people like to complicate things which are very simple actually. They don't like it simple. They can't hazam nahi hota hai khana. आसानी से मिला तो Just neglect it. Not important at all.
Hello, sir.
Yeah.
So it is always advisable to buy it in the money, right?
No, I never said that. Did I ever say? Anybody heard that?
No, means it's just my doubt.
No, it's not that way.
Okay, sir.
If you want, at the money will give you highest gamma and highest delta.
Okay.
So at the money or near the current market price, those strike price usually give the best returns in the terms of percentage returns. In the money will give you slightly more risk, because if you bought in the money call and the stock goes down, you will lose entire intrinsic value. Okay.
Got it.
So it's not that in the money will always is better. No, it's not like that.
Okay.
Sir, Rama here. You said at the money delta is 0.5. Does that mean
around 0.5, slightly up or down?
So does that mean if the stock goes by 1 rupees, delta at the money will rise maximum by 0.5?
Yeah.
Not more than that?
No.
Okay.
But then as we see, theoretically it is 0.5. It will be approximately somewhere between 0.4 to 0.6 you get usually.
Okay.
Sir, Vivek here. Actually, other day you told like for the risk for naked options for 1 lakh rupees, how much we can maximum take? So this question.
No, for naked option you cannot sell in for 1 lakh. You require same as futures margin. I already told you that.
No, for buying option. If
for
you are
buying option, you don't need 1 lakh. For buying option, you will need whatever is the option premium. You don't need 1 lakh for that. Now, if you see here, this Bank Nifty call, this is 1100 rupees. So 1140 into 25. So say 27,2800 you are going to need for buying 1 lot, not 1 lakh.
Correct.
Okay?
Yeah, okay.
Hi, sir. Kalash here.
Yeah, Kalash.
Yeah, wanted to ask, since the margin for selling the future and selling the options are the same, what would
Nearly
you
the same, yeah.
recommend in a bearish view?
Huh?
What would you recommend for the bearish view? Would you sell an option or sell a future?
No, you cannot generalize it for a simple reason. Bearish means how bearish? If it is strongly bearish, then I'll say short future or buy put. Okay?
Oh, okay, sir. Thank you, sir.
Now see what happens. If I short future, I'll require 1.5 lakh in premium. If I buy put, I can easily buy 2 or 3 lot put in less than half the price. Understood? The difference between the two. So buying put then becomes much convenient than shorting future, because my risk is low. My reward is good because I have multiplied it by 2 or 3 times. Okay.
Hi, sir, Pratyush here. So
Yeah,
I got a little bit confusion about the margin part. Now let us take the last 2 examples of 25th March call option 36,000 and Bank Nifty 10th March 36,000. So what will the margin required to put in this order, sir?
Buying or selling?
Buying, sir.
Huh?
Buying.
Buying, see, whatever is the option premium multiplied by lot size.
Okay, that one is there.
Only that much for buying.
Yes, sir. Now you told me that, for example, I'm selling the 10th March 36,000 option. So
now, as long as you are buying an option first and selling the option afterwards,
sir,
margin will be much lesser.
First buy, then selling, sir. You're telling, sir.
First buy and then sell, then the margin required is much less. Around now, even now, volatility has increased, but still you will require something like 35,000, 40,000, something like that. Because it will depend on which, if it is the same type of option you are buying and selling in the same stock, then margin required is less.
Understood, sir.
But you should buy first and sell later. If you sell first, then first of all, it will directly ask you for 2 lakh margin. Okay. So first buy and then sell, you require much lesser margin.
Thank you, sir.
Good evening, sir.
Yeah.
Sir, I am Ravi Sharma. My question is that if suppose my view is bullish and on Friday evening, Friday suppose say 3 o'clock, my for Monday my view is bullish. So then if suppose I buy a call, then Friday to Monday time value will be decrease.
Decrease, yes.
So then it is advisable to buy on Friday or not advisable?
No, you can buy on Friday. What you can do is instead of buying for the immediate next Thursday, buy it which expires after a few days. Buy it for the month end.
Okay.
See, if you have 1 month to expiry, Friday to Monday, 2 days gone. So 2 days loss in 30 days is relatively less. 2 days loss in 7 days is more than 40%, right? Nearly 40%, 35%.
Got it, sir. Got it. Yes, yes.
But then, you know, better strategy. I'll tell you here what is better. If you are taking position on Friday and if you want to hold it till Monday, what if over the weekend some bad news comes and market opens gap down on the next day, or that is on Monday, or you have bought put and Nifty opens gap up, you will be in loss. So instead of just buying a call, you buy call at the money and sell call out of the money. So if it goes down, some compensation you will get from the sold call. Instead of naked call, naked option buying, it is better to buy one and sell other of the same time. Your risk becomes low. Now that all we are going to study in this course, how to reduce the risk. Okay. But I don't advocate buying naked options for overnight position. Intraday, it's okay. Chalta hai. Overnight position, very rarely you can do that. When there is a very sharp uptrend or downtrend, then you can do it. Not every time. All right. That is what strategies are all about. Any other question now? It's already 6:30. Any other question to anyone? No question? What is there in chat box? There are a lot many things there I have not seen. There is no time decay in futures. Time decay in futures, but then you lose the cost of carry. That is there. So it's not actually zero time decay. All right. And futures risk is also more. Don't forget that. Option, you can choose which option you are going to buy. Understood? Future, the problem is if it goes up, your loss will, suppose you are shorted future and market goes up, your loss will be unlimited. If you have bought puts and market goes up, maximum what you will lose is the time premium, that margin which you paid initial premium of, only that much. So your risk remains under control. So you cannot generalize this way or that way. You have to find out the best possible strategy. Okay. What would you recommend? Selling options or selling future in bearish view? Again, the same thing. If your view is very strongly bearish, then you can sell futures. Because selling call option will give you only limited money. If your view is strongly bullish, then only you can buy future. Selling put will hardly give you time premium and only risk you will be taking. So don't generalize this. What is the difference between spot price and strike price? I think I have explained already. Spot price is what is the price in the cash market right now, and strike price is for the option which contract you are making. Above that or below that, you will get or you will have to pay the compensation. Okay. Now, any other questions to anyone? Anything else you want to ask? Option price calculator I have already shown you. I have also shown you how to use that. Anything else you have not understood? Risk is more in stocks of Bank Nifty. See, risk means what? Bank Nifty, of course, has more risk because it is leveraged. Stocks are not leveraged. But if you leverage the stock, the risk will increase even in that. So if you pay only partial margin to your broker and you buy bigger stock position, fine, you are equally leveraged. Then even the risk is equal over there. So futures as such will be riskier, but rewards are also huge compared to stocks in spot. If you're talking of futures of both, again, you cannot generalize there. Depends on stock to stock. Some stocks are more volatile. Some are less volatile. Stable stock will naturally have lesser risk, lesser reward. What is the best option strategy for daily apart from expiry day? If market is bearish, buy put intraday. Intraday strategy is buy put and get out of it when your view changes from bearish to bullish. Intraday. Okay. When you say daily, I take it as intraday. Yeah.
So is there any app for option premium calculator?
Why you need app and all? Yeah? You can just maybe there. I don't know. I don't waste time on that.
Okay, no problem.
Okay.
Okay, sir.
See, option premium calculator. As I told you already, option premium, the time decay and everything, when it comes into picture, when you have a naked option, then it comes into picture. I keep naked option almost always only intraday. And overnight, I rarely keep naked option. Usually, I create strategies where one is bought, one is sold. Sometimes one is bought, two are sold, something like that. So they take care of all these anomalies. Okay. Sometime at expiry, premium goes very low. Premium goes very low, price to very, very high. Means what? I have not understood your sentence, Naveen. I have not understood what you are saying.
Sir, one question. Like in naked option, if you're taking so
buying, selling,
buying. So what is the maximum risk you will take in this?
Whatever premium you have paid.
Okay, but we can. Okay, I got that. But
whatever premium you have paid, only that much risk is for the buyer of the option. Naveen, I did not get your question. Meaning, what you mean by this? Is option strategy for indices applicable to stocks also? Yes. Yes. If liquidity is there, it's applicable. Many stock options don't have liquidity. That there I cannot help it. There you don't use it. Even for currency, it is applicable. Again, commodity options don't have liquidity. Most of them don't have. Okay. Is there any strategy for weekly expiry to get minimum profit without risk? None direction, bank nifty. There is strategy. We are going to study that. There is nothing like without risk. Some risk you have to take. It's a business. You take calculated risk. You lower your risk. Okay. We are going to study that. Don't worry about it. Any other question?
Sir, can we put a stop loss in this?
You can put stop loss, but if the option is liquid enough, then you can put stop loss. If it is an illiquid option, somebody will see you put a stop loss, he will just grab it, and then again price will go in your direction which you anticipate. Okay, so instead of keeping a stop loss, you go for a strategy which will protect your capital automatically. Stop loss also doesn't make it zero loss, right? Some loss is always there, even with the stop loss. So why not control it instead of just placing the stop loss? Lower the risk. Any other question here?
Sir, there is no M2M in this option. No?
Yes, it is there. Especially when you are writing option, there is M2M. Even buyer option, there is M2M. M2M is there.
So daily it is.
Daily it is settled. Daily it is settled. See, if you sell option and you later on you are in loss, what if you run away? So M2M settlement is always there.
In option also.
Yes, yes. Any other question now, or we'll stop over here today? Right. So that completes the basic theory of options. So from next time, we are going to start with the actual trading strategies in options. Okay. So thank you all. Now, some of you had to complete the payment of fees in this week. Don't use the older links which I had given you. I'll send you a fresh link. Don't use the older link. It is the older link is giving me some problem. The money is not getting transferred to my account. It is taking from you, but not sending it further. So don't use that link. I'll send you a fresh link. Okay. So thank you all.
Thank you,
Today we'll stop here. Next Sunday we are going to continue.
Okay. Thank you so much.
Thank you.
Thank you.